Welcome to this explainer where we're going to completely transform the daunting, frankly jargon-heavy world of the stock market into a highly actionable, step-by-step blueprint. So if you've ever felt totally overwhelmed by all the financial noise or just unsure of where to even begin with building your wealth, you are absolutely in the right place today. We're going to cut right through all that static and give you a really clear, structured path forward.
But before we put a single dollar into the market, we really have to address the fundamental question every single beginner asks when navigating financial risk. And that is, how do you invest without losing your shirt? I mean, it's a very real fear, right? Behavioral scientists actually note that loss aversion, which is just the fancy term for the fear of losing money, often plays a much bigger role in our decision-making than the excitement of gaining wealth. So knowing that, we absolutely have to manage that risk right out of the gate.
Okay, so here's our 5-step roadmap for today. We'll be covering laying the foundation, asset allocation, choosing investments, optimizing accounts, and finally, staying the course. Let's jump right in. Step 1, laying the investing foundation. Think of this literally like building a house. You just cannot construct a solid financial portfolio without first laying down a completely secure, protective foundation. And that foundation begins with an emergency fund of 3 to 6 months worth of living expenses, held entirely in cash. This is your ultimate buffer against unexpected financial shocks. Because whether it's a surprise medical bill, a sudden job loss, or, an emergency home repair, having this cash on hand ensures you're never forced to sell your investments at a loss just to cover your daily needs. So with our cash buffer safely in place, we've got to define our risk tolerance. Academics consistently note this is the single biggest factor in how you're going to behave during a market crash. The official definition from the SEC highlights two very specific words here: ability and willingness. Understanding the massive difference between those two words is honestly the secret to surviving market volatility. The crucial takeaway here is separating your emotional willingness to take risks from your actual financial ability to withstand losses, which is all based on your unique circumstances. Look, your willingness is purely psychological. It's how much market turbulence you can stomach before you start losing sleep. But your capacity, that is purely mathematical. If you need cash to buy a house in 2 years, your capacity for risk is incredibly low, no matter how brave you might feel. On the flip side, if you're saving for a retirement that's 30 years away, well, your capacity is high, giving you plenty of time to recover from any temporary market downturns. Step 2, defining your asset allocation. Now that we actually know our risk capacity, we can start drawing up the overarching blueprint of our portfolio. Asset allocation is basically just the strategy of dividing your money into different buckets. And what's truly fascinating here is that studies have shown this one single decision explains virtually 100% of your fund's returns over time. You are fundamentally balancing risk and reward by adjusting the percentages of stocks, bonds, and cash you choose to hold. Stocks are generally going to offer you higher returns, but with higher volatility, while bonds offer lower returns, but give you a lot more stability. This brings us to a brilliant quote that perfectly illustrates why diversifying your assets across those different buckets is universally celebrated by financial experts. It reduces your overall portfolio volatility. Because different asset classes often perform very differently under the exact same economic conditions, combining them properly reduces your overall risk without perfectly correlating their drops. It literally is the only free lunch you'll find in the investing world. So, how much actually goes into each bucket? Well, a really practical life cycle investing rule to determine the split is 100 minus your age, meaning a 25-year-old might subtract 25 from 100, leaving them with a target of holding 75% in stocks and 25% in bonds. Alternatively, a 55-year-old would hold 45% stocks and 55% bonds. It's a great little rule of thumb because it automatically adjusts your risk downward as you age, and your investing time horizon naturally shrinks. Let's look at some real historical data between 1977 and 2024 to see this in action. It's pretty wild to see exactly how adding bonds smooths out those severe market drops compared to a 100% stock portfolio. If you were 100% in equities over that time, your best year was a massive 37% gain, but your worst year was a devastating 37% loss. Ouch. Now look at the 50-50 split. You still captured a really solid 28% gain in the best year, but you limited your worst year to just a 16% loss. That right there, that is the absolute power of asset allocation at work.
Step 3, choosing your investments.
With our asset allocation blueprint finalized, we can zoom in and pick the actual bricks we're going to use to build the portfolio. How do we do this without getting overwhelmed? Well, it beautifully strips down to exactly 4 simple steps.
First, we just figured out our asset allocation. Second, decide which market index you want to mirror, like the S&P 500 or maybe the total U.S. stock market. Third, check the fund's prospectus to ensure it actually has a high correlation to that index. You really want a fund that matches the index 95% or more, not one where managers are secretly trying to stock pick behind the scenes. And fourth, you simply pull the trigger and place the order to buy.
Now, you might be wondering why focus on indexes. The reason is simple and mathematically proven. Passive index funds beat active investing strategies a staggering 80% of the time. Instead of trying to guess and pick winning companies, using index funds that mirror the entire market ensures you get broad diversification, incredibly low fees, and historically superior results. You're essentially guaranteeing yourself your fair share of the overall market's growth without paying exorbitant fees to a manager who is, statistically speaking, likely to underperform anyway.
Step 4. Optimizing your accounts.
Okay, so we have our investments, but step 4 is all about deciding exactly where those investments should live so we can protect them from taxes. Because remember, what you earn is important, but what you keep is what actually builds wealth. It makes a massive mathematical difference over a few decades if you prioritize tax-advantaged retirement accounts before placing your overflow money into currently taxable brokerage accounts. In a 401k or an IRA, your earnings compound tax-free. That big chunk of money that would normally go straight to the government every single year is instead staying right in your account, working for you and multiplying. A standard taxable brokerage account should really only be used for shorter-term goals or once those tax-advantaged accounts are completely maxed out. This specific strategy of placing the right investments into the right tax buckets is known as asset location, and you can think of it as the protective roof over your financial house. You always want to take advantage of an employer 401k match first, because that's literally free money. Next, if you expect your tax bracket to be higher in retirement, you want to utilize a Roth account where your withdrawals are completely tax-free later on. And finally, if you do end up using a taxable account, you want to place highly tax-efficient investments in there, like those broad index funds we just talked about.
Step 5. Staying the course. Finally, we have to prepare for what is without a doubt the hardest part of this entire process, managing our own behavior. Even though you've chosen a completely logical asset allocation, maintaining it is incredibly difficult when you're faced with these very common human psychological traps. When the market is booming, investors suddenly decide they want way more risk. When the market crashes, they decide they want less risk and they panic sell. People are constantly trying to predict the exact optimal time to jump in and out of the market. And let me tell you, that is nearly impossible, and poor timing will severely damage your overall returns. If you ever feel tempted to panic, just look at this historical data from the devastating 2002 bear market. It proves exactly why you absolutely must rely on your pre-planned stock-to-bond split. During that crash, an investor holding 80% stocks and 20% bonds suffered a massive 34% loss after inflation. However, an investor who had properly aligned their risk capacity beforehand and held 20% stocks and 80% bonds actually saw a 6% gain during that exact same terrible economic period. Your asset allocation dictates your burden during a bear market. So as you prepare to actually take these steps, building up your emergency cash, defining your risk allocation, buying broad index funds, and properly utilizing tax-advantaged accounts, I want to leave you with this final thought. The math of investing, that part is already solved. The real question is, do you have the discipline to see the strategy through? Make no mistake, the market will test you. But with this blueprint in hand, you have the exact structure you need to succeed. Keep learning, keep building, and let the long-term math work in your favor.